One topic that's shaping up to be the debate of the summer is whether inflation is transitory or not. Many experts are weighing in on the topic, including my next guest. He is Ronald Stöferle, and he is responsible for fund management and research over at Incrementum AG. And they've just issued a full in-depth report that highlights and talks about the issue. It's called In Gold We Trust. This year's edition is called Monetary Climate Change. Ronnie, welcome back to StansberryInvestor.com. Good to speak with you.
Hi, Daniela. Good to see you. And you did great on saying my last name. Fantastic.
I'm practicing, right? The more I have you on, the closer I'm getting to success. As you know, I hate butchering people's last names. So thank you for your patience. Ronnie, you've put out an incredible, really detailed report on gold. And we're going to try and hit as many parts as I can in this interview. A big chunk of the report is dedicated to the topic of inflation. As we know, this is the debate of the summer. Everyone wants to know, is it transitory? Is it not? The Fed says, hey, the economy is not getting overheated. But most experts I say it definitely is. How do you see things, Ronnie?
Well, we're seeing it really from a holistic point of view. And the title of the report is Monetary Climate Change. So from our point of view, it is a structural change that we're seeing. And I don't think it's transitory or temporary. I think that over there at the Federal Reserve, they enjoy listening to Guns N' Roses because they keep telling us all we need is just a little patience. And we have to be patient, everything is going to calm down. But nobody's really telling us what temporary really means. Is it going to be 1 month? Is it going to be a couple of quarters? Is it going to be a year? And I think the Federal Reserve also underestimates that inflation very much is a lagging indicator. So at the moment, we're already seeing market-based inflation expectations are at a 10-year high. We're seeing 10-year break-evens close to a decade high. University of Michigan consumer survey jumped from 2.4% to almost 5%. So inflation is a topic again. Now, the question that we try to answer in the report is, what are the big underlying structural drivers? And there are actually a number of them. First of all, I think that velocity was one of the main reasons why we haven't really seen a big surge in inflation over the last couple of months. Now, velocity is stabilizing as the economies are opening up. So rising velocity will meet a flood of liquidity that was created over the last couple of quarters. The second point that I would like to stress is that Asian countries now start exporting inflation. I think many market participants underestimate the massive deflationary pressure that China basically exported after their massive devaluation of the yuan in 1994, and the Chinese market opening up to the world, not only China but also Eastern Europe. There was a huge deflationary movement over the last couple of years. This is now ending. Then we're seeing, from my point of view, we are super bearish on the US dollar. Once we go below this 89 support level, I think the next support levels would be around 83. I think that demographics, which is very much of a long-term driver, is turning more and more inflationary. We're seeing that globalization is kind of having a hard time. We're seeing this politicization of credit. We're seeing a fundamental break in the way how money is created. We shouldn't forget that we're moving now from monetary dominance to fiscal dominance. The White House is really desperate in putting out new fiscal stimulus packages, basically almost on a daily basis. And I think it is really a big shift that we're seeing, this move from primarily monetary stimulus to primarily fiscal stimulus. And also, I think the whole ESG developments. Another song, I think it was Alanis Morissette, "Isn't it ironic?" I think that actually the whole ESG development, which is of course a positive development, is also creating inflationary pressures, for example, in the oil market. So all in all, I think this pendulum, this big pendulum, is swinging from stronger deflationary forces to stronger inflationary forces. And this is what we're describing in the report.
So Ronnie, which sectors will benefit and will not? Let's talk about equities, bond markets, and of course, gold here.
Well, you don't have to have a CFA to know that bonds don't really enjoy rising inflation rates. I think that's fairly obvious. But I think it's not so obvious that actually the equity markets, once we go above this kind of feel-good zone of inflation, equity markets are really getting a hard time. There was a great study by Citi that was put out, and that basically the conclusion was above 3%, equity markets are facing massive headwinds. So I think when it comes to inflation, many people think, equities being real assets and they should profit from rising inflation. That's just not supported by the facts. You really have to focus on the pricing power of the sector and the companies. You have to know more about about the debt levels, how they're financed, and so on. So from my point of view, what's really the main impact for investors is the classical 60-40 portfolio would basically be deprived of its basis, which is the negative correlation between equities and bonds. So at some point, and I think we're close to this point, I think that this negative correlation between equities and bonds will flip. So that means, bonds have performed, have never performed well in inflationary times, but it will become even more problematic if bonds are held as an equity hedge, like it happened over the last couple of years. So from my point of view, this is really the big topic. And just to give you one number, at the moment, there are roughly 13 trillion invested in negative yielding debt. That amount is roughly the equivalent of the GDP of the entire European Union. So that's not peanuts. And if inflation is really, if market participants are realizing that inflation is not temporary, not transitory, then I think there will be an exodus out of those bonds. And we crunched the numbers and the conclusion is clear. What are the asset classes with the highest inflation beta? That's commodities and it's gold.
And it's gold. So let's take a deep dive there, Ronnie. What kind of price action can we expect from gold? We saw what happened last summer. It ended up being the best year ever for gold. Can we expect more fireworks this year?
Well, I don't know if you enjoy Italian soccer, Daniela.
Ronnie, what
Italian
kind of
football
is this? Of course.
So okay, so you're also looking forward to the Euro, and you know what catenaccio is. So basically, gold
Defense.
Let's put it that way. Trust comes from repeatedly fulfilling expectations, and I think that gold did a tremendous job last year. It acted as your stable and reliable defender. Mm-hmm. Of your portfolio. So these catenaccio qualities, as we called it, they played out really well last year. Gold was up 24% in US dollar terms, 15% in euro terms. Gold really delivered. It did its job. Now people, I think, became a bit greedy, and of course we saw a correction over the last couple of weeks due to rising yields, due to also some sort of competition from Bitcoin, probably due to a stronger US dollar a bit later on in the year. But then we saw this double bottom in March at 1680, and I was pretty vocal on Twitter, and that's not what I'm doing normally, but I said, the sentiment is so negative. Nobody really cares about gold anymore, and our indicators are wildly bullish. Now we're trading roughly at 1900, and actually nobody cares about gold. we are so close to the all-time highs. And from my point of view, having a look at market positioning, having a look at sentiment indices, they are fairly neutral. So I think this is a tremendous setup that we're seeing. We shouldn't
Right.
forget, in May, gold was up almost 8%. We're seeing that systematic buyers like CTAs, like trend following systems, I think their models are switching to a positive view. We're well above the 200-day moving average. So I'm pretty constructive, I would say, on gold at the moment.
I mean, it's really psychological though, right? I mean, once you hit a high, you want more, you want more. I remember when I started covering gold, gold was below, $1,000. And then when it hit 1,000, that became, well, we want more than 1,000. We want 1,200, 1,400, 1,500. So the same thing is happening now, I would say. So I think it's normal that people now, are wanting the 2,200, 2,400, 2,600, because we see the fireworks that's happening in the cryptocurrencies, and gold investors want some of that action.
Well, yeah, I mean, I think last time we talked, I made this comparison, gold being a solid, stable, reliable SUV, while Bitcoin is like a Ducati Panigale, like a really, really strong motorcycle. And we started, once it starts raining, of course, it's getting a bit dangerous and slippery on your motorcycle. However, I think that this whole comparison or competition between gold and Bitcoin is ridiculous. In our funds, we combine both. But of course, the volatility of Bitcoin is tremendously higher, as the track record is not 5,000 years. So from my point of view, we have to really manage expectations when it comes to gold. Gold's job is not to make you rich. I think, mining stocks can make you rich. Silver can perhaps make you rich, cryptos and so on. The job of gold is to preserve your purchasing power, to protect your savings. And I think gold is doing that job pretty well.
That is so well said, Ronnie. And I think that's something that a lot of investors tend to forget. It's not that road you take to get rich quick, basically, but like you said, to preserve your wealth. But that said, your report does highlight and pay a big portion of attention to silver. And you're identifying silver as the next great opportunity. You say, why silver? Well, as explained in last year's In Gold We Trust report, the metal is far and away the most heavily leveraged exchange traded commodity. In August 2020 report by Macri put the ratio of derivatives to physical market at 193 for silver. That's the second largest derivatives market relative to the underlying physical commodity was nickel at only 86. Gold's ratio was 74 to 400. It was no surprise silver was chosen. So you expect silver to be a breakout star here?
Yes, I think, if you have a look at the chart of silver, it looks super explosive. It looks like a pennant formation or a flag. We're trading above the 50-day moving average for 2 months now. Once we go above this 28.9 resistance, I think we will quickly go to 30. That's the big number. And then basically there's no big resistance. The next one would be at 34, which is probably out of the year 2012, I think. And I think, for silver, it's not only some sort of levered gold. It is also in inflationary times, silver tends to outperform gold. Now, of course, last year, for the first time in the In Gold We Trust report, we wrote a big chapter about silver. Back then, the gold-silver ratio was at 125. Now it's at 68. Is silver now expensive versus gold? No. I mean, it's still above the median. And if we look at the gold-silver ratio at the end of previous inflation periods, it reached 16 in 1980 and 31 in the year 2011. And from my point of view, silver, first of all, it will profit from this whole green wave that we're seeing, and that is now really picking up momentum. We're seeing a tremendous amount of new demand coming from the photovoltaic industry, industry, from electric vehicles and so on. We should not forget what's currently going on in Peru. Peru is the second or third largest producer. It holds by far the biggest silver reserves. And if you have a look at what Mr. I think Castillo is saying, well, the silver industry will probably have a hard time in Peru. So therefore, I think from a technical point of view, but also from the mental point of view, silver looks terrific. And I think that honestly, with the whole Reddit squeeze, yeah, I think that first of all, I was a bit critical because I said, hey, we don't need such an orchestrated short squeeze. But I think now the consequences are pretty positive, because silver is really, people are having silver on their watch list and they're researching it. And I'm seeing quite a lot of interesting pieces coming out. We're also seeing that lots of physical demand is coming in. We're seeing that investors' demand has picked up significantly since February. So that's really a terrific setup that I'm seeing in silver.
All right, silver, the one to watch. Ronnie, like I said, the report is just full of incredible information. Thank you so much for coming on StansberryInvestor.com to talk about it. Thank you.
Thank you very much, Daniela. And I'll cheer for Austria and Italy at the Euro.
Forza Italia. And Ronnie, I have to say, I appreciate all the song references in the report. I saw you also included Silver and Gold by U2, one of my favorites. So thank you for that.
You're most welcome. Thank you very much. Take care.
Oh, one last thought for you, Ronnie. I have to bring up a part of the report I loved and was fascinated by it. And maybe you could explain a bit about it. Is you created your own ratio of gold to buying Oktoberfest beer. Tell us a little bit about this.
Well, that's probably one of our most popular charts. Because over the last 15 years, I realized that there's a very high correlation between gold bugs and beer drinkers. So we said, well, we want to show this long-term role of gold preserving your purchasing power that we talked about before. And there's actually a very long time series for the price of 1 ounce of 1 liter of gold of liquid gold of beer at the Munich Oktoberfest. And we found out that the average inflation rate at the Oktoberfest is roughly 5%. So which is probably very close to the inflation rate that many people kind of feel and think that is really more accurate than the inflation statistics that are published. So we calculated this ratio between how many liters of beer you can buy with 1 ounce of gold at the Munich Oktoberfest. And unfortunately, due to COVID, they had to cancel it for the second time in a row. But we still brought up this ratio, and it's telling us basically that the purchasing power of gold at the moment at the Munich Oktoberfest would be at the average level, at the long-term average levels, which suggests gold isn't super cheap, but it's also not super expensive like in the year 1980. So yeah, that's one of the more fun charts, but I think it really makes sense to show how gold is protecting your savings and how it protects your purchasing power. And why not make a big report also a bit entertaining?
Absolutely. Cheers to that, Ronnie. Thank you so much.
Thank you very much. Take care. Bye-bye.
Take care. And thank you for watching this edition of StansberryInvestor.com. We will have much more for you coming your way, so be sure to stay tuned. In the meantime, remember to share us where you watch us. That's it for me. I'm Daniela Cambone.